So, good morning to today's presentation. Welcome. My name is Peter, your senior market analyst at IronFX. In front of your screens, you have the US dollar index. It's the 4-hour chart. All charts to be presented are to be of the same time frame unless otherwise stated. And as we're going to be jumping from time frame to time frame, no worries, that will be mentioned as well. Now, starting with the US dollar index, there are two elements which should be highlighted. Definitely on a technical level, we note that the US dollar index has broken the upward trend line guiding it and stabilized somewhat. That's since Friday, early Friday. That forces us to actually switch our bullish outlook in favor of a sideways motion. Now, before we proceed with any further indications about the movement, allow me to switch the role of the R104.35 from a resistance line to a support line. Let's go further back, hunting for a new ultimate resistance line. This peak is indicated, but also this one. I'm going to be holding on this one. And that would be in red. The 108.30. Readjusting the chart. Let's correct the labels. Starting with the S3, which is now being placed at 101.90. The S2 at 102.95. The S1 at 104.35 used to be a resistance line, now turned to support, given that the price action is above it. The R1 at 105.45. The R2 at 107. And the newly indicated R3 at 103.8.30. Sorry. Let's lock everything in. Now, on technical level, given that the price action seems to be, for the time being, respecting the S1 104.35. At the same time, we note that the RSI indicator has dropped slightly below the reading of 50, but remains very close by. These two indications tend to imply that the upward movement has been interrupted, along with the fact that the upward trend line has been broken. And we switch our bullish outlook in favor of a sideways motion, possibly between the S1 104.35 and the 105.45. I would be noting, though, on a more fundamental level, two issues. And the third, as a side note, I would be highlighting any articles and any discussions about the Fed's intentions. For the time being, the market seems to be convinced that the bank is to remain on hold, maybe even cut rates early next year. Any indications that the Fed may proceed with more rate hikes, which could come out of more hawkish Fed policymakers, could shake the basis of the market's perceptions and actually provide some support for the USD. I would be highlighting to that end the release of the US CPI rates for August. They are due out on Wednesday. And the interesting part is that the headline CPI rates are expected to accelerate a bit. Okay, it's not a major inflationary issue, but it shows a persistence, a stubbornness on behalf of CPI rates to actually drop lower, which may force the Fed's hand to actually harden its stance. And at that point, that could take out two elements. The first element would be practically the possibility of the Fed prolonging high rates or even proceeding with more rate hikes. So these are two elements which are interlinked and should be closely watched out for. Another issue, which is a little bit more fundamental, a little bit out of the picture, we tend to maintain deep worries about the US-China relationships, which are already well damaged. And the question is whether there are going to be new frictions or intensified tensions, given that we had the discussion about the restriction for Chinese officials to actually use iPhones. Given also, though, on a deeper level, the fact that Huawei was able to produce its own microchip, which is quite advanced, and that tended to create some worries in the US. There was characteristically some statements by US lawmakers in Congress that the US should impose even harsher, I wouldn't say tariffs, but at least I would say sanctions on China. And that could drive safe haven inflows for the USD. These are the three fundamental factors which could provide renewed support for the US dollar. On the flip side, should we see more and more Fed policymakers more or less readjusting the stance and maintaining a more, or if you prefer, less hawkish stance, less hawkish view, and start tilting more towards the dovish side, that could create some, I wouldn't say substantial, but still some weakening for the greenback. Also, a substantial weakening from the greenback could come from a possible deceleration, which is currently unexpected, of the CPI rates for August, as that would solidify market expectations for the Fed to soften its stance. Should the bulls take over, which is one scenario for the time being, let's not forget our base scenario here is for the US dollar index to remain relatively unchanged between the R1 and the S1. For a bullish outlook, I would require clearly a break of the R105.45 and the price action to start aiming for the 107 resistance line. On the flip side, should the bears take over, for a bearish outlook, we would require the index to drop, break below the S1 104.35 and start aiming clearly actively for the 102.95. That would also allow us to draw a downward trend line, something like this. Let's have a look at Euro USD. Let me readjust slightly the labels. Let's move upwards. So, once again, three elements. A, the price action has broken the downward trend line which has been guiding it, yet seems to be well respecting the 1.0870 resistance line, the R1. At the same time, please note that the RSI indicator has reached, yet remains slightly below the reading of 50, implying a rather indecisive market, which more or less may allow the sideways motion to continue. Also note how the Bollinger Bands have narrowed And actually, the 20 median, the median, which is the 20 moving average, has flattened out. All of that tend to pinpoint for a possibility of a sideways motion to continue between possibly the 1.0870 and the 1.0765. We're talking about a distance of around 105 pips. Not much of a distance, but still seems to be quite valid. Now, the euro side, definitely euro traders are going to be focusing on ECB's interest rate decision. We have a broad affair between the hawks and the doves in the ECB, whether the bank's going to be hiking rates or remaining on hold. On the one hand, the hawks actually are pointing towards inflation, which seems to be quite stubborn in the Eurozone. And they highlight the need for another rate hike, at least one more. On the other hand, the doves tend to imply that CPI rates have dropped and may drop even further. And that builds the case practically for the bank to remain on hold, that it has already proceeded substantially with rate hikes. Let's not forget Christine Lagarde's statements that the bank has proceeded within the last year with consecutive hikes of a total 4%, which is quite substantial, thinking that about a year ago it was at 0. Currently, Euro OIS seem to imply that the market expects the bank to remain on hold, keeping the deposit rate at 3.75 and the refinancing rate at 4. Yet Euro OIS, okay, there is a majority in favor of remaining on hold, but it's not so convincing. We're talking about a probability of around 60%, 7%, which I would say that does not highlight the certainty of the market for the bank to remain on hold. On the contrary, it seems to imply that the market is more split. That was up until this morning. It's going to be quite interesting to see if the market expectations are going to be shifting. Now, I would also be highlighting the possibility of an energy crisis in Europe, given also the fact that we have strikes. We had partial strikes on Friday. Chevron's LNG plant in Australia. Let's not forget that Europe, after actually imposing sanctions on the imports of Russian gas, has been seeking gas all over the place. Interestingly enough, the Germans take it a step even further and more or less require that from 2024 all new housing will have heating pumps with expectations to replace practically natural gas, coal is already not existent, within the next 4 to 5 years. It's a very, very strict rule. There's lots and lots of reaction in Germany about this new law. And it's a big issue, but it's highlighting exactly the energy crisis in the Eurozone. I would expect that most probably the market will remain in an undecisive tone should the ECB or the market's expectations for the ECB to remain on hold intensify. I wouldn't be surprised to see Euro USD actually dropping, breaking the S1 1.0765, maybe even breaking below the 1.0670. On the other hand, should the hawks have it, we may see the euro strengthening, pushing practically Euro USD higher, breaking the 1.0870 and start aiming for the 1.0945. And we've talked we've talked about the euro's fundamentals. Let's not forget that euro USD has on the right hand side also the US dollar. So US fundamentals are expected to affect the pair as well. Should the US dollar weaken, that would allow practically euro USD to rise, break above the R1 and start aiming for the R2 1.0945 and vice versa. Let's have a look at GBP USD. Now, GBP USD, allow me to reposition the labels. In a similar movement as the euro against the US dollar, the pound has broken the downward channel guiding it and seems to be about to test the R1 1.2675. The RSI indicator is running along smoothly, the reading of 50, implying a quite indecisive market about the pair's next leg direction. Should the bulls take over, we may see GBP USD rising, breaking above the 1.2675. Actually, for a bullish outlook, it would be a prerequisite along with the pair reaching or at least actively aiming nearing the R2 1.2815. That would also allow us to draw a nice upward trend line, showing us also the limitations of the upward movement. Now, should the bears regain control over cable's direction, we may see the pair dropping, breaking the 1.2540 and start aiming for the 1.2355. Now, the outlook for the GBP is a little bit dark, and actually we're a little bit pessimistic about it. What you're seeing right here in the chart is more related to the US dollar rather than the pound as such. I think that pound traders are going to be increasingly focusing on the release of the UK GDP rates that due out, if I'm correct, on Thursday. And should there be another slowdown, at least on a month-to-month basis, along with the manufacturing output growth rate on a month-to-month, that could weaken the pound somewhat. But I would be also highlighting before that the employment data, mainly for July, which are due out tomorrow during the European session. I think they're going to be an interesting read, and should there be further indications that the UK employment market has eased, that could more or less, allow me one sec, that could more or less highlight exactly the difficulties which BOE is facing on its rate hiking path. I wouldn't say that they're crucial, but they could play a substantial effect on BOE's interest rate decision. I think it's next week. So let's keep an eye on it tomorrow as well. Okay, let's have a look at USD/JPY. Let's readjust the labels a little bit. Quite a proud analyst on USD/JPY today. We had a drop of USD/JPY from the 146.60 all the way down to the 144.60. We're talking about a drop of around 200 pips. It's an issue in the sense that yeah, 200 pips, sorry. It's an issue in the sense that what instigated the strengthening of the US dollar, of the JPY during today's Asian session was the comments which were made by BOJ Governor Weather. Now, the BOJ governor practically stated or expressed his optimism that the bank will be able to escape negative interest rates. Okay, he didn't mention that for the short term, but still, that was a quite optimistic comment which tended to provide instant support for JPY. At the same time, we note that the weakening of the US dollar allowed the pair to edge lower. I would be noting here, though, that despite the drop, the pair seems to have hit a floor on the S144.60. And in my opinion, the drop actually highlighted the potential for the sideways motion of the pair to continue between the R1 and the S1. For a bearish outlook, I would require the pair to drop below the S144.60, have a clear break, maybe even the S1 providing resistance at some point, and start aiming for the 142.25, nothing less. Should the bulls take over, we may see the price action of USDJPY rising, breaking the R1 146.60. Actually, that should be... Guys, I'm sorry, we're going to have to readjust the chart as we had a recalibration on the R1. The R1 now is being placed at 147.80. Here you go. The S1 is now being placed at 146.10. It has broken above it. And the S2 at 143.70. The S1 at 140 is the S3 at 141. Here you go. Sorry for that. So we tend to maintain a bias for the sideways motion to continue between the R1 and the S1, 146.10 and the 147.80. Given that the pair seems to be respecting both levels a couple of times, for a bearish outlook, we would require the pair to drop below the 146.10 and start aiming for the 143.70. On the other hand, should the bulls take over, we may see the price action rising, breaking the R1 147.80 and start aiming for the R2 149.40. Okay, let's have a look at AUD/USD. It's the 4-hour chart. Let's readjust it. Let's readjust or reposition the labels. Okay, we see that the sideways motion is being maintained here between the R1 and the S1. That should be no issue here. That's clear. Give me a sec. You can see the sideways motion in the yellow rectangle. It's highlighted. especially given the rise during today's Asian session brought the pair exactly in the middle between the R1 and the S1. The RSI indicator, though, on the other hand, has risen above the reading of 50. It's currently at 61, which could be a sign that a bullish sentiment seems to be building up within the market. Yet for a bullish outlook, I would require the pair to clearly break the R1 0.6510 and start aiming for the R2 0.6610. On the other hand, should the bears take over, we may see the price action dropping, breaking the S1 0.6380 and start aiming for the S2 0.6285. On a more fundamental basis, I would be highlighting for the Aussie practically two issues. The first would be the release of the Australian employment data for August. Should there be indications of a tighter Australian employment market, that could provide some substantial support for the Aussie. Although we have to warn you guys here that market expectations are ready for the Australian employment market to be a little bit more tighter, with employment change figure rising above zero. I would also be highlighting China. It's a major risk factor right now for the Aussie. And do we expect the release of the industrial output growth rate for August, as well as for the urban investment? And I would be also noting the retail sales growth rate for China. Now, all of those indicators, growth rates, should they slow down, could more or less weaken the Aussie, as they may imply less exports of raw materials from Australia to China. The two economies are very closely linked, and actually China is the main trading partner of Australia. And should there be an indication, or if you prefer further indication, that the Chinese economy is struggling, especially in the manufacturing sector, that could more or less weaken the Aussie side of AUD/USD and push it below the S1 0.6380, start aiming for the S2 0.6285. Let's have a look also at USD CAD, with the Canadian dollar gaining yesterday on Friday. There you go. Let's reposition the labels. USD CAD, which seems to have broken the 1.3485 support line, which now is actually even providing some resistance. I think that would be more obvious. Allow me to drill into the 1 hour chart and zoom it in. See how that has started to provide even a slight resistance. That tends to imply that the downward trend line may continue through it. In the 4 hour chart, it's not so visible. Back to the 4 hour chart. There you go. Now, definitely we have to readjust our levels. The S1 becomes now the first resistance line. Let's go hunting for a new ultimate resistance level. Sorry, support level. I would be noting this show here. It's very, very interesting in my opinion, and it's very characteristic. In green, that would be the 1.3320. Locking it in. Let's correct the labels. Starting with the R3 at 1.3775. Moving now to the R2 at 1.3660. Moving to the R1, 1.36. Okay, there are some objections about the R1, which I tend to consider also as valid. The objections are for the R2 to be raised up here. Okay. Let's do that. And that would be the 1.3670. We're talking about 10 pips. Sorry. That should be 90. Let's have a look at the S1, S2, S3. $1.35 for the S1. Setting the S2 at 1.3430. Setting the S3 at 1.3320. And we're done. For the time being, we tend to maintain a bias for a downward motion to continue, and that's being based practically on two elements. The first is the fact that the price action has even slightly broken the S1 1.36, now turned to resistance. Mind you, the RSI indicator is dropping and has reached the reading of 40, implying that bearish sentiment seems to be building up, and that may allow the pair to drop even further and start to actively aim for the 1.35. It's characteristic that if we extend the downward trend line, it shows us where the price action of USD CAD is heading to. So from all of us here at IronFX, we hope that you found this discussion useful, and best wishes for solid trading.
Hello, my name is Christina and welcome to another video. This time we will talk about liquidity and volatility in Forex. Let's start with liquidity. So, what is Forex liquidity? Liquidity in the Forex market refers to the ability of a currency pair to be bought or sold without major changes on its exchange rate. Simply put, when you can easily buy or sell a pair, it is considered highly liquid. In fact, the amount of money that flows in the market as well as the number of traders that want to buy a certain asset determine the level of liquidity. When there is a decrease in liquidity, there are fluctuations in the quotations. During such periods, buy and sell order volumes can change many times. Now, which are considered the most liquid pairs? Euro USD, USD CAD, GBP USD, USD JPY, AUS USD, GBP JPY, Euro JPY, USD CHF, and ZD USD are some of the most liquid pairs. They have the highest available trading volumes. However, as markets open and close across the globe, their liquidity can change throughout trading hours. Did you know that the daily Forex trading volume has reached $6.6 trillion, making the Forex market the most liquid worldwide? You can be confident that in such a market, you will always be able to buy or sell an asset, as there will always be someone available and willing to buy or sell. This is what liquidity is in a nutshell. Stay tuned for part 2, where we will talk about volatility in Forex. Thank you for watching.
Ahead and get started. So today we're going to be talking about the turtle trading strategy. Before we get started, as per usual, just a risk warning as well as a disclaimer. The information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. The material is just the opinion of the authors, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from or from any information contained herein. Redistribution of the material is strictly prohibited. Okay, so I'm Melanie and I'll be your speaker for today. I'm from Everest Fortune Group, who are finalists for Best FX and Equity Research in the years 2019, 2020, and 2021. Okay, here's our agenda for today. So firstly, we're going to be talking about who exactly were the turtle traders. So some background on turtle trading strategy. What exactly was this strategy? Breaking down the strategy, how we can improve the strategy in today's day and age, and crafting your own strategy around the turtle trading strategy. Okay, so let's go ahead and get started. Okay, let's get started. So here's the history or a little bit of background around turtle trading. It is a trend-following trading methodology that was developed by Richard Dennis and William Eckhart in the 1980s. So the total trading strategy, also known as the total trading system, is a famous trend-following trading methodology developed in the 1980s. So Richard Dennis was a prominent commodities trader, while William Eckhart was a mathematical genius and trading mentor. The origins of the total trading strategy can be traced back to a bet between Richard Dennis and his friend William Eckhart. So they had a disagreement about whether traders could be taught or if successful trading was an innate skill. So to settle the debate, they decided to conduct an experiment by recruiting and training a group of individuals who became known as the Turtles. So Richard Dennis believed that successful trading could be taught, while Eckhart believed it was a required natural talent. So Dennis, known for his colorful personality, famously said he could teach anyone to trade successfully if they followed specific rules. So the total experiment was aimed to prove his point. And this actually came after a trip to Singapore where they saw a turtle farm. And that's, hi Deepesh, welcome to today's webinar. Let me know if you can't hear me or can't see me as well. So this actually the idea for this experiment came after a trip to Singapore where they visited a turtle farm. So that's probably the reason why they called it the turtle experiment. So in 1983, Dennis and Eckhart selected a diverse group of people, and there were actually a couple of thousand of people who applied to be part of this turtle trading experiment. So they selected a couple of people from different backgrounds with no prior trading experience, and then they began their extensive training program. So they taught the turtles a specific trading methodology, which included entry and exit rules, position sizing, and risk management techniques. The core principle behind the turtle trading strategy was trend following. The turtles were taught to identify and trade in the direction of significant market trends, where they used a combination of technical indicators, such as moving averages, to determine entry and exit points. So we'll be going through a couple of these rules and strategies later on in this webinar. So they were also trained in strict risk management rules. They were instructed to follow a position sizing methodology known as the N unit. So this approach adjusted the size of their trading positions based on the volatility of the market, limiting the risk exposure. So you can see over here, I've indicated a little graph to show you what exactly the N unit was. So N equals to the market volatility. Here we have a, I wouldn't say a graph, but it's just a brief drawing of the volatility measured across a number of days. Then we used the DMA, 20 DMA, to measure the average true range of the volatility of the market. And this is how they were trained. So after the training period, the turtles were given trading accounts that were funded by Richard Dennis. And then they applied the rules that they had learned, and then they began trading his real money. So the experiment was eventually considered a success, as the turtles collectively generated significant profits over time. So at the end of the experiment, after a year, their total profits were $175 million. So the total trading strategy gained widespread attention and became well known in the trading community. The rules and principles of the strategy were eventually published in a book called The Complete Turtle Trader by Michael Covell, further popularizing the methodology. So the turtle trading strategy demonstrated that with proper training and adherence to a set of rules, individuals could achieve success in the financial markets, even though they had no prior experience. So it highlighted the importance of systematic approaches, risk management, and following market trends, and it continues to influence traders and investors to this day. Okay, so what exactly was their trading strategy? So some key takeaways from this, we'll go in depth a little later on, but for the specific set of rules, their entry was to buy when the price breaks above the 20 or 55-day high or low. And then similarly, you will go in for a sell if price breaks below this specific indicator. So for stop loss, it's pretty much subjective. It's solely based on your ratio, of course, but it was based, there was no specific rule for that. And for risk management, it was 1 to 2% of your account, and vice versa for short trades. Okay, so some key takeaways after the experiment. Even though it was considered a tremendous success, market conditions are always changing, and some question whether this style of trading could survive in today's markets. So the turtle trading is based on purchasing a stock or contract during a breakout and quickly selling on a retracement or a price fall. So he actually turned an initial stake of less than $5,000 into more than $100 million. So let's get into the specifics of the turtle trading strategy. Firstly, we'll go through the breakout trading, which is what I mentioned earlier, one of the main features of this trading strategy. And since it's also based on a trend following pattern, we're going to be talking about that as well. Position sizing and risk management, long and short trades, as well as multiple timeframes and diversification. So those are all of the ways that the participants of the experiment were trained to use this turtle trading strategy. So firstly, let's start with breakout trading. The core principle of the turtle trading strategy is to identify and capitalize on significant market trends. Breakout trading is a popular technique used by the turtles, where they enter trades when the price breaks out of a defined range or a previous high or low. So this approach aims to capture the momentum of a new trend and ride it for maximum profit. So in this case, they use the Donchian channels, which we'll get into in a little bit. Okay, next they looked at trend following. So turtles primarily focused on trend following, which means they trade in the direction of the prevailing market trend. So they use technical indicators such as moving averages or Donchian channels to identify the direction of the trend. Traders can employ various trend following techniques to enter trades when the trend is established and exit when it shows signs of reversal. Okay. So next we have position sizing and risk management. So proper position sizing and risk management are integral parts of the turtle trading strategy. Risk management is still pretty important in today's context for any trading strategy, but we'll get into that a little later on in this presentation. So turtles use a method known as the N unit to determine the size of their positions based on the volatility of the market. That's what we mentioned earlier. So the idea is to risk a fixed percentage of their capital on each trade, ensuring that no single trade significantly impacts their overall portfolio. Next, we have the long and short trades. So since they're not only limited to only taking long positions, they can also utilize short selling to profit from the declining markets. By following the same principles of trend following and breakout trading, turtles identify opportunities to go short when a downtrend is established or when the price breaks below a significant support level. Okay. So multiple timeframes. Turtles often analyze multiple timeframes to gain a broader perspective on the market. They might use a higher time frame, such as the daily or weekly chart, to identify the overall trend, while using lower time frames like the hourly or 15-minute chart for precise entry and exit timing. So this multi-time frame analysis helps them to capture both the big picture trends and the shorter term opportunities. So even though in this slide we are saying that they analyzed multiple time frames, the main time frame that they use to actually trade on is only the daily time frame. So that was a rule that was set by the originators of this experiment to only trade on the daily time frame. So as we mentioned, if you were here for our multi-time frame analysis webinar, once you've decided on a specific time frame to use, then you could use either the 4 or the 6 multiples to gain a broader perspective on the market. So for example, if you were trading on, let's say, the 4-hour time frame or 1-hour time frame, let's say, then times 4 would be either the 4-hour, or if you were looking at a higher time frame, would be 4-hour, and if you're looking at a lower time frame, would be either the 15-minute time frame. Just so that you can get a bigger perspective on both the smaller time frame as well as the larger time frames. But we always go from a top-down approach when we're looking at time frames. So we typically will look at the daily time frame first or the weekly time frame, followed by either the 1 hour or the 4-hour time frame. But in this case, the participants of this experiment only looked at the daily time frame when they were trading. Okay. Next, we have diversification. So another aspect of the turtle trading strategy is diversification. Turtles trade across different markets and instruments to spread their risk and increase their chances of finding profitable opportunities. So they may trade commodities, currencies, bonds, or other financial instruments simultaneously, depending on their expertise and market conditions. Okay, so let's break down their strategy. Earlier, we mentioned that they use either a 20-day setting or a 55-day setting. And I also mentioned that they solely only used the 1-day time frame. So here I have them side by side. Here is my 20-day setting, and here's the 55-day setting. This is a Donchian channel, just to be extra clear with you guys. You can see on the 20-day setting that the Donchian channel is much closer to the price. This is used for more short-term trading, or if you are a scalper, this is the 20-day setting is recommended for scalping and short-term. Whereas the 55-day setting, you can see that there's a lot more space between the prices, and they only really measure, or rather they only really take a look at the significant swing highs and swing lows and any small movement in price. Big movement in price, sorry, not the small movements in price like all of these. Whereas if we're looking at 20-day, you can see that there are these, it pretty much follows price more closely. So for on the 55-day setting for the Donchian channel, this is more for long-term traders because it's more refined, and this is typically what we recommend as well. It's a better way to trade as well, or it's more useful compared to the 20-day setting. Okay, now let's take a look at how we can improve on that strategy. So firstly, we have moving average. MACD, even though that's the first option, we either use MACD or moving average, but I'll show you guys on TradingView in a little bit on how we can make use of both of these indicators to improve the total trading strategy. Okay, so here's the moving average that we can use from the Donchian channel. I'm just going to go ahead and open my TradingView to show you guys how exactly they used it. Okay, so over here, we're looking at Euro USD. Let me just clear my charts. Okay, so they analyzed it solely on the daily time frame, but as we mentioned earlier, they did look at the weekly time frame. So let's go ahead and look at weekly as well. Okay, so here we have the weekly time frame. You can see prices have climbed up from this swing low, but it does look like price is reversing off of this level over here. This is our weekly time frame. Okay. Okay, my mouse isn't working today, so I have to use the keypad, or rather the mouse pad on my laptop. So if you can hear that, that's the sound of the clicking. Okay. So here we have the daily time frame. You can see prices are climbing up. So I'm going to pull out our Donchian channel. So here we are using the 20 length time frame. I'm going to go ahead and remove our moving average first. So we're just solely looking at the channel for the time being. Okay, so how they trade was that, for example, over here, if price made a lower low, so for example, over here, we see price has made a lower low over here, then they will go in for a sell. That's basically the rule that they had. So from here, if price cuts below the previous low, then they will go in for a sell, sorry. Yeah, but if we're talking about stop loss as well as take profit, as we mentioned earlier, stop loss is it was subjective. There wasn't really a set rule for that. So if you placed your stop loss over here, or rather if they placed their stop loss here, they would have gotten stopped out, right? So if we go back, let me zoom in. Okay, so we're looking just solely over here. So if, over here, sorry. So once price made this lower low, from here, it made a lower low, it cut below this area here, right? Then they went in for a sell. But if we had placed our stop loss over here, so you go in for a sell from here, you're expecting prices to drop. If they had placed their stop loss right at the entry over here, they would have gotten stopped out because price rose up before it continued to go back down. right? So price, which is why we always recommend you to place your stop loss before any big area of confluence. And what we mean by big area of confluence, over here we have this swing low here, as well as a swing low here. So this area, okay, let me just get rid of this. So when you have this area here, this is considered an area of confluence since price has tested this area many times before. Okay, see, I can even drag it all the way back over here. Okay, price testing this area many times. So this is what we call a confluence area. So for them, once price cut through here, this specific area, which is our previous low, they're going for a sell over here. Stop loss is subjective. So if they had placed it anywhere over here, they would have gotten stopped out because you can see price reversed up over here. That's why we always say we want to place it before any major confluence area. So we'll get into risk management a little later in this presentation, but I just wanted to point that out since we're looking at a chart now. Okay, so then they would have gone in for a sell and they wouldn't know because these people don't have prior experience. So they would have gone in for a sell, just wait for price to drop all the way until here. So this could be our take profit over here. So that's basically how they traded. It's using the Donchian channel. Basically, when price keeps making a lower low, then they just go in for a buy or a sell. So maybe another example that we can have over here would be at this take profit, where price made a lower low over here. The minute it cuts through here, they were going for a sell. But you can see price reversed all the way until here. Right? And once again, this is a significant level because price has tested this. We have two multiple swing highs here. So this, once again, is a confluence area. So if they had placed their stop loss over here, they would have gotten stopped out. So we always recommend place it before your confluence area. And then you can see it go down, then they would have made a profit over here. Okay, so that's basically how they use just channel. So now let's take out let's add, okay, let's also change this to 55. So this is why we say that using the 55 would be better, because previously on the 22, okay, let's change it back. You can see on the 20, it's following price very closely. So it's a little bit difficult to see if price made any lows. Whereas when we have our 55, you can see really clearly. You can see from here to here, for example, where I pointed out earlier, it's very clear that price made a low, another low after this previous low, even without my support level. So here, one look, you can see exactly where price has made a lower low, and then that's where they will go in for a sell. So that's just the Donchian channel alone. Let's add the moving average. Okay, so similarly, as we mentioned earlier, they would go in for, they're looking out for breakouts. So an example of this would be over here, for example, price is moving below the moving average, but then once it comes up above here, above the moving average, they will go in for a buy. which of course you can see that it did drop, which is why we say again, depending on where the stop loss is, if it was here, it would have been fine. But if it was exactly at the swing low, they would have gotten stopped out before price reversed. Because you can see price did reverse here, and then it went back up, and they would have made this much of a profit. So it's not the best trading strategy, of course. Now that we are in modern day and we know some other trading strategies, but this is basically what they did. A very simple set of rules to follow, which actually resulted in them making a big amount of profit in the span of 1 year. And the thing is that they couldn't miss out on these breakouts as well, because since they're trading on the daily, they only have 365 days minus the weekends to trade as opportunities for them to trade in the experiment. Okay, so whenever they saw a breakout like this, they had to go in for it. Okay, I think another thing that helped as well was that maybe because the financing wasn't exactly their money, so they didn't have the issue of emotions that most traders face, since most traders would be trading with their own money. Yeah, but the money wasn't theirs, and they also had the confidence of an experienced trader backing them up, telling them that this strategy was going to benefit them. So since they didn't really have any emotions as well as insecurities that were tied to this trade, it was probably easier for them to trade as well. Okay, so that's basically the gist of what happened or how they used to trade. So let's get back into another way that they use this trading strategy. So after using the Donchian channel, they also made use of stochastic. So let's go ahead and look at that. Stochastic is a let me just change this. Okay, it's fine. It's an indicator that we like to use as well, because it shows us the momentum of price as well. So typically in today's day and age, how we use stochastic is by looking at trend breakouts. It's by looking at divergences as well. If you were here for our stochastic webinar, you would know that. So similarly, how they used it as well in combination with the Donchian channel is by simply looking at whether it's overbought or oversold. So you can see over here it's oversold, right? So then they were going for a buy. That's basically how they used stochastic. So they didn't look at divergences at hidden resistance and support levels like we do today. They just looked at if it's overbought, then they were going for a sell. If it's oversold, then they were going for a buy. That's what they did back then. Okay, let me know in the chat if you guys have any questions as well. We're just going through what exactly they did and how exactly we can improve on it with our hindsight, now that we know better. Okay, so now let's talk a little bit about trade management, which I mentioned a little bit earlier on. So why is trade management so important? So firstly, it's to control risk. So by having trade management strategies such as stop loss orders and position sizing, it helps traders to limit their potential losses and manage their overall risk exposure. So earlier on, I was talking about how where exactly is a good idea to place your stop loss. In terms of position sizing in the context of the experiment, they actually position sizing, they only placed 1 to 2% of their total capital. So the total capital that the original creators financed for them, they were only allowed to use 1 to 2% per trade. So that helped in terms of position sizing. Stop loss was completely subjective and completely up to them. So in today's context, when you are trading with your own money, position sizing, it's again up to you in terms of your capital and your risk appetite. But leverage and margin would help a lot as well in terms of what lot size and what position sizing you would want to use. Okay, secondly would be to maximize profits. Trade management strategies such as take profit orders and trailing stop loss would help traders to lock in their profits and maximize their returns. Third would be to manage your emotions. So as I mentioned earlier, these participants weren't exactly trading with their own money. So perhaps this wouldn't have applied to them. But for us as normal traders, the discipline and structure that trade management provides can help us to stay calm and rational, even in volatile markets, which can prevent impulsive decisions driven by fear or greed. Okay, number 4, to improve trade efficiency. So if you have a well-defined trade management plan, traders can make faster, more informed decisions and avoid the cost and time of having to constantly monitor and adjust your positions. And lastly is to increase consistency. So effective trade management rather, can help traders to achieve consistent results over time by reducing the impact of individual losses and maximize the impact of winning trades. So in summary, trade management is important regardless of what trading strategy you use. If you're interested in using the total trading strategy, it's important to implement your own trade management as well. Okay, so right now let's take a look at some trade management strategies that you can implement together with total trading strategy as well. So earlier on, I was talking a bit about confluence. Over here in the slide, we're talking about Fibonacci confluence, but as I mentioned when we were looking at the chart, it's confluence pretty much for anything. So if you have a couple of swing highs that lie in the same area, that's a pretty strong level. And if you combine that together with, let's say, a Donchian channel or a pivot point indicator, and all of those levels line up, that's a confluence area as well. So it doesn't only have to be for Fibonacci. But in this case, we're talking about, in this slide, it's talking about Fibonacci. Okay, so stop loss, earlier I was mentioning that you place your stop loss beyond a key confluence area. Why? Because price is attracted to strong areas of confluence. So earlier on, I showed you that if you placed your stop loss right before a area of confluence, then you'll get stopped out. So similarly, if your stop loss is right before instead of beyond it, you'll likely get stopped out before the market reverses, which is what I showed you guys in the chart. So take profit, on the other hand, we want to place it before a key confluence area. And why? Because when price reaches the confluence area, there's a high chance that it will not be able to go beyond it. And instead of reaching your profit target, it reverses back to your entry, or even worse, to your stop loss. So this is also one of the reasons why people complain that the market is being manipulated, because they miss their take profit by 1 pip. Okay, so here's just a diagram to show you the proper stop loss and take profit placement. So this applies for really any kind of trading strategy. So the proper stop loss and take profit placement ensures that you maximize your wins and minimize your losses. So for example, in in this example over here, I showed you guys this red area is our confluence area, and that's why we place our stop loss beyond it. So over here, you see similarly major resistance area, which can be considered as our confluence area, stop loss, we'll place it beyond so that we don't get stopped out. Similarly, for take profit, we want to place it before a major confluence area so that there's a higher chance that price will hit our take profit before reversing off. So let's see if we can find any potential take profit areas. Okay, so for example, over here, okay, if I had placed my, okay, let's say, here, okay, this is my area of confluence, and I'm expecting price to go back up here, right? Because as we mentioned earlier, the participants, once price breaks out of our moving average, they will go in for a buy, right? But then we can see after they go in for a buy, it drops down. So in the same way that we would place our stop loss after here, just in case price reverses off, which it did, once it goes back up, where will we place our take profit? So since stop loss, we place it above. If we place it over here for our take profit, it would have missed our take profit before reversing back down, right? So we would place our take profit before. And you can see that the candle wicks just nice touch our take profit. Okay, and that's why it's so important for you to place your take profit before a confluence area. Okay, let me know if you have any questions, but we're just going to go through some risk management techniques. Okay, so here we have break even. So I'm just going to briefly go through these trade management techniques, but we go through them in depth in our upcoming trade management series, so keep an eye out for that. But here's just a brief run through that you can use in combination with the turtle trading strategy. Okay, so break even. Break even is a level where you are in profit and recognize that there's a risk of a reversal, which basically means that price is going to hit back to your entry. So it is basically saying if I am right, price should go all the way back to my target, but if I'm wrong, I should get out. Okay, so let's take a look at the diagram here. Here we have our entry firstly, which is the blue dotted line. Buy entry on breakout, hoping for price to push to our take profit. So the gray highlighted area here is a double swing high resistance. And you can see price has broken out of this resistance. So we're expecting it to continue to rise. We're expecting to continue to rise and head towards our take profit. And our take profit is over here at this green area. Okay. But you can see our original stop loss is way down below here. Even after, or rather beyond, as we mentioned earlier, it's beyond this swing low over here. Okay, so between the blue and the yellow dotted lines, price is trending, it's moving upwards, right? And then it goes up above this this level here, and we're expecting it to hit our take profit, but we can see that it reversed right over here. So if we're not entirely sure whether price is going to hit our take profit, that's where we add our break even, which is at our, or rather, it doesn't have to be a swing high, but it just has to be at a level that's in between your take profit and your entry. Okay, so to minimize losses even more, we changed our stop loss. So we placed our stop loss at our break even, or rather at our entry, which is over here. We place our entry to protect our position. So if price continues to rise, it's a good thing, of course, but if it reverses, we will want to be protected and to get out as soon as possible. So we got out of this losing trade at break even. So we got out over here because you see price definitely reversed off and we got stopped out here. So if we had left our stop loss over here, we would have lost a lot more money. Okay, next we have idea invalidation. So idea invalidation is usually placed before your stop loss. Is the level which you basically admit I'm wrong, let me get out. So when this level is reached, your take profit is moved to your entry, giving you a small chance to get out at break even. So let's look at the diagram here once again. Your entry, same thing is over here. We're expecting price to drop all the way down to our take profit over here. Okay, so it's going down nicely, and then over here it reverses and it heads back up. So once it hits our entry, then we realize that we're wrong, and then that's where we place our take profit to our entry. So that gets us out of our losing trade. So you can see once we realize that we're wrong, we place our take profit at our entry, and then we get out of the trade at break even before price rises further and would have stopped us out. So this is two ways in which you can minimize your losses. Okay. Okay. Here we have different methods of trading stop loss. So this is another way to minimize your losses is by having a trading stop loss. So there are many different methods. So I'm not going to get in depth. I'm just going to briefly mention a few. So here we have moving average, which is the first one, followed by parabolic star, chandelier, and ATR indicator. And then over here, we have the support and resistance levels and a combination of these methods. Okay. So these are really important when you are using any kind of trading strategy. Doesn't even have to be a turtle trading strategy, but since we mentioned earlier, by looking at the turtle trading strategy, where exactly are good places to place your stop loss as well as your take profit to maximize your returns and minimize your losses, I figured we just add this in as well. Okay, that brings us to the end of our webinar. Let me know if you guys have any other questions, but thank you guys so much for coming to our webinar today. Hope you guys found it helpful, and I will see you guys next week. Bye! Feel free to let me know in the chat if you have any questions as well. Okay, seems like there are no questions, which is great. So, yep, I will see you guys next week. Have a great rest of your week and see you guys soon. Bye!